sense of what we're thinking now. We know the market's acting up a bit, unnerving some people. It actually has come a very long way. We've hit record highs, even in the global indices now, the Morgan Stanley All World or MSCI All World Index. So we've come a long way, and we think that this will be that refreshes, just to get to the bottom line there. But we'll get into why we think that after we go through the normal drill here. So we start with fiscal policy, then monetary policy. We'll then go to economic indicators, some market indicators, and then we'll talk about the correction and what we see from here. And as you know, we're very long-term in our focus. Everything we do has a 5-year investment time horizon associated with it, whether it's our research or our portfolio. So we'll talk about the world from that angle in the context of what's going on today. So on fiscal policy, well, I guess Congress couldn't get it together for another relief package. So we do have the executive order in place, which does defer payroll taxes into next year. Now, if the president is to get reelected, I believe he's saying that there will be forgiveness of that deferral, or at least he'll rally Congress to try and get it. And if not, then workers will have to pay double taxes next year, double payroll taxes, in order to make up for this deferral. So it is perhaps bringing some activity into this year that might a little faster than might otherwise have been the case, but it wouldn't be as powerful as forgiveness of payroll taxes, both for employees and employers, for the rest of this year. Nonetheless, it is something. On monetary policy, well, we got some more information from Fed Chairman Powell in the last week or so. And the information was essentially, we're very focused on both employment and inflation, a little more emphasis than perhaps historically on employment, given where we are right now, still a very high unemployment rate. We'll get into that in a minute too, given today's report. But there was a very interesting nuance he introduced on the inflation side of the equation. We thought he was heading in this direction. Essentially, the policy response is going to be asymmetric. If inflation rises above 2%, and based on the core PCE deflator, which is the inflation metric that the Fed seems to like the best, it now is at 1.3%. But if it were to go above 2%, the Fed essentially would allow it to continue to move above 2% in order to make up for lost time. We've been under 2% for so long. And we're not even sure the measure is correct. If ARC is right, that is overstating inflation, even the 1.3%, given all the deflationary forces at work in the economy. But at least the Fed is saying if the measure itself crosses 2%, the Fed is not going to react right away. And on the other hand, if it drops below 2%, let's say it goes above 2% and then drops below 2%, it will act right away. So that's what we mean by asymmetric response. So again, the Fed is reassuring the markets that it has their back. You wouldn't know it from this week, but the Fed certainly is willing to err on the side of easing too much. So that's information, and that's important. On the economic indicators, today was an important day. The first Friday of every month usually is. We got the unemployment report. Unemployment dropped back into the single digits. I think most people are very surprised that happened before the election at all. We peaked at 14.7, as it turns out, and we're down to 8.4%. Of course, we were below 3% in January, February. So still high in relation to where we were before, but essentially will nearly cut in half, which is a lot of work done in just a few months. Some of the other interesting statistics out of the report, just to underline how strong the economy is and how much of a V-shaped recovery we're in. Household employment was up 3.7 million. Now, household employment is a different metric. Non-farm payroll employment, what the survey measures is what businesses tell them. Household employment is what households tell them. And so it captures more small businesses. And so what I think this is saying is even small businesses are getting back to work. And we know that small business formations, new formations have surged. So what we are seeing is, sure, a lot of bankruptcies and probably a lot more to come. But what these entrepreneurs do is turn around and start all over, especially now that they are being treated more like larger corporations and can declare bankruptcy and get out from under their debts. And I still think that's being underestimated in here in terms of the positive impact that that is having on the economy. The work week also went up. Now, going up 0.1 hour doesn't sound like a lot, but that's the equivalent of, I think it's disproportionate in terms of its impact on economic activity relative to the increase in employment. And what we saw in the manufacturing sector was a 0.3 of an increase, 0.3 of an hour increase in the work week, plus a 0.1 increase in overtime. What this is telling us, reinforcing, is that businesses are scrambling to keep up with demand. They have been way behind the curve. They were behind the curve before the coronavirus, and they were going to have to make up for a lost time, even if the coronavirus had not hit. They became even more conservatively postured during the coronavirus. And now that the consumer is really coming out flying, they're having to scramble to catch up. I don't know if any of you are experiencing this, but when I go to the supermarket, I'm seeing, not in the toilet paper shelves, but in many other shelves, they are not as full as they normally are at my supermarket. It's a little village market. They try to keep everything fully stocked, and they can't. So I do think there's a bit of a scramble here, even for food and so forth.